Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading week ending February 21st, 2025. I'm Preston Brent. Thanks for tuning in. Well, the theme this week is, do we want to buy the dip or not? Well, let's just take a look at where the markets are and what I think could be coming our way shortly. If we look at this, you can see here, everybody was in the red this week, and finally the Russell broke from the green into the red year to date. Most of the year to date returns were cut almost in half this week. You could see Russell was down over 3.7% for the week. Nasdaq 2.5, S&P 1.6, Dow was down pretty hard too for the week, 2.51%. I mean, it was a holiday shortened week. Sharp losses really came in the second part of this week. The negative shift in sentiment really happened on Thursday, the big shift, kind of partially due to Walmart's Q4 earnings. They say their guidance for the year ahead was a little bit short of expectations, mostly regarding consumer spending and the health of the overall economy. So that kind of set the markets down on Thursday. We also got retail sales that followed from the prior week, which showed that retail sales dropped the most actually in 2 years this past month. So these two things kind of set things on a path. I want everybody to note that the U.S. military expenditures right now are about 1.1 trillion in 2024, and they were eclipsed by the interest expense of 1.12 trillion. So now our interest expense is starting to grow dramatically, even more than military spending. And even though the US represents 70% of the world's equity market valuation, we're starting to see some cracks in the armor here. Okay, just cracks, nothing dramatic, but just cracks. The other thing I'm seeing is the shadow banks or non-bank lenders, mostly in private credit, they're holding about 63 trillion in financial assets globally at the end. This was at the end of 22 going into 23. It's even grown since then. That's about 78% of global GDP. So if we do have a credit crunch, markets are going to react very ugly to all of that private credit. So these are some of the things I'm starting to see. The other thing is the week's economic data did really little to improve consumer sentiment or confidence. I mean, Tuesday we got home builders. It said that their housing market index was 42 in February. That was down from 47 in January. And by the way, that's the lowest level in 5 months on home builders. And the sentiment is not that good. In addition, we saw January housing starts decline about 10% from December. So the other thing that I'm seeing is the S&P Global reported U.S. business activity growth came very close to stalling in the month of February. The flash PMI came in at 50.4. Of course, anything below 50 is contraction. Anything above is expansion. So just barely. And services entered contraction territory with its lower PMI. It's the lowest we've seen in 2 years. It came in at 49.7. So, and then finally, we got the University of Michigan consumer sentiment. That dropped about 10% month over month. So all in all, we're seeing a dramatic slowdown in the U.S. economy. We're seeing an increase in U.S. debt. Inflation is sticky. So if you look on the screen there, you can see valuations in the upper right-hand corner are still very rich at 22.57. It's a high valuation, guys. The 5-year average is around 19. And that's still hot, very high. Okay. Treasury yield 4.43, earnings yield 4.52. And you can see the real yield is about 152 basis points over inflation right now. Current VIX closed out the week at 18.21. So the VIX finished up for the week. It wasn't really flat for the week. It was up about a little over 10%. So that's kind of where we are there. And then you can see the best and worst performers for the week. Staples was the best. It's a risk-off sector. Discretionary was the worst. That's a risk-on sector. Healthcare is leading the way annually for year-to-date performance. Discretionary is leading the way to the downside year-to-date performance. So we're seeing a flight to safety right now as I'm looking at the markets. Okay, U.S. Treasuries, as I said, kind of a modest midweek rally, um, but with this weak PMI data, it moved interest rates lower as people started going back in, seeking the comfort of U.S. Treasury or U.S. debt. Okay, if we come over and take a look at the neighbors across the pond, the European markets, everybody there was in the red as well. Not as dramatic or draconian as the U.S., but still in the red. But year to date, very solid. You can see 11.84% year to date for the Euro stocks. Really very strong. FTSE up 5.9, double digit for CAC 40 and DAX. We did get the Eurozone expansion PMI data. It stayed in expansion territory at 50.2. It kind of was unchanged from January, but not very strong. I mean, it's most of the markets are just viewing these strong year-to-date numbers across Europe because Europe has been trailing the U.S. for 10 years, and last year and the year before dramatically lower than the U.S. returns. It's almost like a dead cat bounce out of Europe. So that's kind of what we're seeing to kick off this year. Meanwhile, in the UK, the composite PMI still came in over 50, declined a little bit. So globally, the markets are slowing down as we're seeing by these global PMI data. And we are getting UK inflation. Um, Basically, this forcing the markets to reduce the bets on 3 interest rate cuts by Bank of England this year. We're seeing CPI data accelerated to 3% in January in the UK. That's the fastest rate of acceleration since almost a year ago, March of 24. Okay. So, all in all, inflation is sticky, credit is high. Um, the risk of credit defaults is going up as well. So we've got to be very careful here with these markets. Now, if we look at Japan, you can see the Nikkei is in the red, not only weekly, but year to date. They're struggling because the yen is continuing to get stronger. I'll show you the charts in a minute. CPI data rose 3.2% year over year in January, slightly ahead of expectations of 3.1%. So that puts more pressure on the Bank of Japan to continue to raise rates, which is what's putting the yen at a stronger stance. And generally, the Nikkei goes in the opposite direction of the yen. The stronger the yen, the weaker the Nikkei, and vice versa. Meanwhile, GDP in Japan expanded more than anticipated, coming in at 70 basis points quarter over quarter from Q4. I mean, the consensus with 30 basis point expansion, but expanded 70. So that's putting more pressure on the Bank of Japan to raise the rates again sometime in the next 90 days. And that does tend to strengthen the yen and weaken the Nikkei. Meanwhile, in China, you can see they're back in the green again. Mainland China, their stocks rose, lifted pretty much by strength in their technology shares. And they had some better than expected earnings from some of the leading tech companies. And we're getting strong results from some of the tech companies out of China, like Alibaba and Tencent and some of these others. And that all really kicked off when their AI startup DeepSeek showed off some of their tech capabilities in January at like 80% cheaper in US. So they're still getting a tailwind on that. But the biggest sentiment in China right now was when their president Xi basically had a high profile meeting with tech companies, and he signaled that the government was going to adopt a more supportive stance towards private sector companies, primarily tech companies. And he's trying to do that to bolster the Chinese markets with this looming trade war with the US and Trump. So he's trying to support the Chinese market. It makes sense. So that's a little bit about where we are on a global level. Where I got the yellow caution flag up. In fact, I was telling our members selling out of the money calls in the S&P and looking at VIX as a way to play it long because these markets are in a tenuous position right now. And so the question is buy the dip or sell the rally. Well, right now we're still in the buy the dip mode, but I think we may have a little bit further to go. Let me just show you the chart here. I'm going to show you the E-mini S&P 500 futures. Let's take a look at that, and you're going to see, just kind of how we're hanging on a thread right now and some key indicators, key technical indicators. If you look here, you can see this red line is the 50 EMA, okay? and we're well below the 50 EMA. Let me just get it situated here. You can see it's almost like a double top. We actually made a little bit of higher high. We had a bearish divergence, not a pure bed. It was more of a bud, but just barely, right? Um, where we had multiple crosses in the MACD, but you could see where we blew right through the 50 EMA. Next stop down in the markets is a psychological level at 6,000 on the E-mini futures. And then below that, it's going to be right where we closed back on February 3rd, which was at 59.82, which is just south of 6,000. If we blow through that, then we're going to challenge the closing price of last year, which would put the markets at a 0% return at basically 59.38. Right, that's where we closed last year. And of course, if we look at the Dow, see where it's located right now. The Dow had a really ugly week. You could see it blew well through the 50 EMA, right? And it's just barely floating above where it closed last year. 200 EMA is near the lows that we made on January 10th of this year. So the damage was done on Thursday and Friday with the Dow. Of course, if we look at NASDAQ, the tech sector, you can see here just barely holding above the 50 EMA. If we break that, then it's going to make a run down to 21,234, which is the closing price for last year for NASDAQ. Okay. This is the NASDAQ 100 futures. Then, of course, if we come down here and look at the Russell, as I said, the Russell is now in the red for the year. Not only is it below the 50 EMA, you can see where it tried to get up above and it failed. We blew through. We're in the red. We actually blew through the 200 EMA. So the upside resistance is going to be what was downside support right at the 200 EMA, sitting around 2220. And we're close to making new lows for the year of the Russell. All right. Now, this momentum, traditionally, if we close hard down near the lows like we did on Friday, that momentum traditionally carries over into Monday. We'll see where this thing goes. And of course, if we look at Bitcoin, you can see on Bitcoin here, we're just barely above where we closed last year, but we are below the 50 EMA. So being below the 50 EMA, we've had a lot of damage done. The NASDAQ 100 futures is the only index above the 50 EMA, but it's close to breaching that level. All right. Everybody's above the 200, but and with the exception of the Russell, in the green for the year. But a lot of damage was done this Thursday and Friday. And let's look at the equal weight ratio of equal weight to SPX. You can see here really starting on the 18th. Which was Tuesday this week, money started rotating into value and the broader index as money was coming out of technology. Because anytime this moves up, this is a ratio chart of the equal weight SPX compared to the SPX. When it's moving up, that just means money's rotating into more value and some of the other broader market. Okay, we do want to see that, but I think this Thursday with Wednesday, Thursday, Friday with Walmart's scare and with some of the credit information that I talked to you about, it really retail sales not coming in very good, and home builders and retail sales and PMI data. It was enough to really just say, let's take some profits and get out of the markets right now. Okay. You can look at the front month volatility skew, how we closed on Friday. We're just almost flatline. All right. Now this is comparing the VIX to the March volatility futures contract. We're slightly in the green, just barely. All right. We were in the red, but as we go into close, so volatility is not that concerned right now. And if we look at the back month vol skew, you could see here we're well in the green. So we're in contango term structure in the back month. And then if we go out and I look at the April, September vol spread, volatility future spread, we're well in the green. So these guys are in the green. The front month is pretty much flat. So that just tells me right now the markets are not that concerned. That's a traditional buy the dip kind of scenario. we've got to watch very closely where VIX goes, because if we do look at VIX, right, this is a daily chart of the VIX. If we look at the VIX, you can see we're in this choppy market zone right here in the yellow. And if I just take it down to, let's say, a 15, let's go to a 15-minute chart. You can see here, starting right around 215, the VIX started coming in, going into close. Even though the markets actually went lower, volatility started coming in. That tells me a lot of short-term traders were taking profit on this vol pop here. So, but understand, we were steady here, and then we had that pop right around the middle of the afternoon. And then boom, we kind of went back again on that, and we got to just see where things are going to open. But just understand that traditionally, with a down day on Friday, you generally see the markets continue the momentum going forward, right? So if we just go back to daily and we look at the 10-year interest rate, you can see here on the 10-year rate, markets actually moved hard lower. Why is that? Well, the rates are moving lower because they move opposite of the 10-year Treasury note. If we look at the 10-year Treasury note, it moved higher. That means it's a good sign. That shows that when money is seeking safety, it moves into U.S. government debt. Now, remember in 2022, when we had a bear market, not only were interest rates going higher, but so were the markets. They were going lower. So, but this is just showing me that money was moving into the 10-year Treasury, right? Which is what you'd want to see. And of course, if we look at 30-year, it was up dramatically as well, right? Near the highs for the year. And that means the 30-year interest rates were moving lower. In fact, if we look at the 30-year rate right here, it's near the lows for the year. Okay. So, I mean, it's just money seeking safety is what we're seeing here in this. Of course, if we look at currencies, generally in times of stress globally, the markets seek out the dollar. Now, I haven't adjusted this yet, but you could see we're slightly in the green, up 27.6 cents on the dollar index. Okay. So generally that, I think longer term, the dollar is going to continue to go lower. That's what Trump wants. I can see the markets doing that. But right now, in times of stress, the dollar is going to be a go-to trade. The other thing that you guys have heard me say over and over again, I've had our members in this thing, is look at the yen. I said go long the yen way back over here, and here we go. And the yen is really running, and if I just back it out, you can see. Now, I had projected a target down here of the yen, but it never really hit there. But we had a little bit of this bullish divergence. And it's just taken off. We've taken out the 50 EMA. We did a retest. It took out the 200. It may retest the 200. Longer term, I think it's going to be moving higher. Right, members, we'll talk about it in our weekly market watch Sunday evening on the best way to play it. But the ideal time was when I was talking about getting in back over here late last year, early this year. And with the inflation higher, GDP stronger in Japan, and the Nikkei down, and the Nikkei is down because of the stronger yen, markets are anticipating another rate hike from Bank of Japan. It generally takes 2 or 3 or 4 months. Japan runs very slow, right? So I could see another rate hike in the next 90 to 120 days, which is why all the money is going into the yen right now in anticipation of that, right? And of course, if we look at the euro, it moves opposite of the dollar. Because the dollar was up, the euro would be slightly down. But if it holds the 50 EMA, I think the euro could go higher. Although I do have a target, believe it or not, of the euro almost at parity, lower. And that would imply that the global markets we're going to start to see a little bit more ugly global markets. Europe's going to get more issues, and the dollar is going to stay stronger for longer than I think Trump likes. So we got to watch that closely. Longer term, I think the euro will go higher, the dollar will go longer. Over the next 60 days, it's about a 50-50 bet where the euro is going to go and where the dollar is going to go. Although I would lean to the euro going lower and the dollar index. The euro going a little bit lower and the dollar index moving higher, right? So it's a sell the rally on the dollar and buy the dip on the euro. netting that out. And then, of course, we come down here to precious metals and look at gold. It barely moved on Friday. It was down just a little bit, but we're near the all-time highs in gold, right? I think it's going to see 3,000, maybe even a little bit higher. Goldman Sachs is forecasting 3,100 by the end of this year. I think it's going to move up a little bit. We will see some down moves. It's a buy the dip in gold, right? If you understand options, there's a fun way to play this. Members, we'll talk about it in our weekly market watch Sunday evening. Okay. Silver, you can look at silver and look at the difference in the charts. Silver is nowhere near the all-time highs. In fact, silver was a little bit harder down than gold. So there's a ratio trade to be made, a pairs trade where you're long silver and short gold. Um, and I think that would work out well because these two generally follow each other. But being long silver, it's a higher beta, meaning it moves faster both up and down. I think longer term, you'd probably make more money in silver being long than gold. All right. Then, of course, if we look at energy, we look at oil. Oil's got some downside pressure to it. You can see this huge move here, testing the lows down here. I think it's going to move lower. I think any rally should be sold. Remember, Trump wants to get the price of oil down. He wants to drill. The other thing is, if he does a deal with Russia, cut some of the sanctions. They didn't say what sanctions, but the only thing Russia does is oil, exporting wise. So, I mean, you're not going to find a bicycle and a TV set from Russia in Walmart. So let's just say it's oil. Um, if they loosen those sanctions, that puts more oil on the market, which means oil is going to go lower, right? And that's what Trump wants. So I think that was kind of his method, if I had to guess, and that would tell me that oil is going to go much lower, right? In fact, my target for oil is in the low 60s. Okay. So any rally in oil, we could get a little bit of a rebound rally. It's going to move lower. All right. And then, of course, nat gas is the bull in the energy market. Look at this. I got to update this too. Not even a bearish divergence here. Why? Because Trump wants to build out the LNG terminals on the Gulf Coast, add as much as he can capacity, and start shipping it to Japan and Europe. And he wants to replace Russian nat gas with Europe, American nat gas to Europe. So that's one of the things he's holding over Europe to buy more U.S. nat gas rather than Russian nat gas. They're still buying some, believe it or not, from Russia. So we're going to see how all of that shakes out. But I do believe, and that gas, by the way, has a very hard time of holding over $4, right? So I think this is a tough one to play. It's subject to bouts of just extreme moves higher, but the odds to me tell me it's sideways and chop and down a little bit, but not too much. But this is what's going on with nat gas right now. Okay. All right, everybody, that's a little bit of a quick view of all the asset classes. Members, I will see you Sunday evening for our weekly market watch. Everybody else, have a good weekend and relax and enjoy basketball and hockey and whatever else you like to watch. Have a good one, everybody. Ciao.